Hey, what's up guys? John here. America has just declared bill strike. We are seeing delinquencies across credit cards 5 times greater than during the great financial crisis in 2009.
Millions of Americans are feeling the financial sting of mounting credit card debt.
Credit card debt delinquencies are taking off. New credit card delinquency rates have surpassed their pre-pandemic level.
For context, the delinquency rate during that period was 6.77% in April of 2009. Now, when you look at Texas, for example, this is coming from NerdWallet. 25% of the entire state with a credit card is behind on that bill. Louisiana, 32%. Mississippi, 39%. Alabama, 31%. Georgia, 23%. Florida and California, 15%. Nevada, 19%. You start to look at these numbers, there's not a single state at 10% or less. Not a single state. What is that telling you? Well, it's telling you that Americans are in really, really dark times. They're in a really big problem. And Jerome Powell and Janet Yellen made us to believe that we're going to have a soft landing. How do you land this plane softly when you have, 1 in 4 that can't afford to keep the lights on? I mean, for context, you got 20 million Americans that can't even pay their utilities right now. 20 million Americans, according to CNN. Right? And so you start to add this up. What you're going to start to see, I believe, this year, because there's not going to likely be a Fed pivot, at least according to the Fed. They're saying that it's unlikely we're going to see a Fed pivot.
Based on the meeting today, I would tell you that probably not the most likely case or what we would call the base case.
Even Apollo, they have almost $50 billion in assets under management. They're saying no Fed pivot this year. So if we're not going to have a pivot and the cost to service debt is going to get more expensive or just as expensive, how are Americans going to be able to offset the rising cost of food, the rising cost of everything?
Americans are paying the price for rising inflation, from the grocery store to housing and transportation.
The amount being spent on eating has hit a 30-year high.
They're not. They're going to continue defaulting. And the situation is going to get worse. So I'm going to break this down. I'm going to show you on Equifax.com. You can see the URL here. I'm going to show you exactly what's going on to help you and position you, because what I think is going to happen is I think we're going to see millions, tens of millions of people being forced to sell their cars, their homes. They're going to be selling Airbnbs. They're going to do whatever they have to do to try to keep their head above water. And that's going to be a really good opportunity to go out there and invest, because at the end of the day, that's what happens during, big problematic periods like 2008, 2009. People went out there, had cash, they had credit, they had stable income. They went out there, bought real estate. They went out there and made really smart moves, and they made an absolute fortune. I think this next couple of years will be an even greater opportunity to do just that. So if you're thinking about fixing your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session for tomorrow, for Tuesday. Take a look at this. So Equifax, 2010, delinquency rates, 2010, 11, it went 5% down to 4, 3%. So, credit card companies, they were able to go out there and make a lot of money. Back then, interest rates on credit cards, 12%, 13%. Now it's 25, 26, 28%. Even with those interest rates, they're still not going to make that much money. Because you think about this, even if they're charging 30%, a lot of these, they have cost, they have expenses. Right? If they're seeing defaults at 20%, they're losing money, right? And then when you see what's happening right now with all of these new policies that are being implemented, for example, Biden administration aims to take down junk fees that hit millions of Americans, reducing late payment fees, which in my opinion will further make the situation worse on delinquencies. Because if you're delinquent and your late fee is $3, $4, $5, you're not really going to stress out about it as much. But if it's 40, people are going to say, you know what, I need to figure out how I'm going to make this bill, how I'm going to pay this bill. Disregarding the negative impact it will have on their credit report, they're thinking mainly about the fee. But if you're a credit card company, that means more losses, more losses. And what I think is going to happen is these credit card companies are going to begin profiling people based on their credit scores even more, based on their income, based on the neighborhoods in which they live, based on their history, based on everything that fits inside of that demographic. They're going to be profiling and being really careful on whom they lend money to. So take a look at this. In 2009, average American had $54,000 in debt. $54,000, right? And a lot of people look at 2008, 2009, and they think that was like 1929. That was the worst period ever. Average home price in America is about $227,000. Average home price now is about $400,000, right? So debt loads back then, $54,000. You know what the debt loads are now? Average according to Business Insider, is $104,215. Now, if you are in Washington, it's $180,000. And if you're in West Virginia, $64,000. So you look at this, average of $100,000. So we're twice, we're worse off by 2x than the GFC, right? So you see this scenario, and then you start to look at certain areas. Like, for example, I saw this on the Hill that McAllen, Texas, 51.7% of people are behind on debt. 51%. El Paso, 46%. Baton Rouge, Louisiana, 45%. Greensboro, North Carolina, 44%. And the top 100 largest metros, average is 30% of Americans are behind on bills, right? Like, this is coming from NerdWallet. This is the data that they're telling us. Literally says right here that this is coming from NerdWallet right here, NerdWallet. So you start to see this and you realize how fast this is moving. So this is a change in average number of credit card trade line delinquents from 2023 and 2022. Look at this, how much more we are seeing defaults. Just skyrocketing, absolutely getting out of control. How many people are in a really, really, really bad spot? And so what I personally think is going to happen is we're going to start to see evictions and rental defaults at levels in which we've never before seen, ever. I mean, even in 2008, 2009, a lot of people thought, hey, look, a lot of people are losing their homes. They had to rent prices went up. In fact, that didn't happen in most markets. In most markets, they actually saw rents being reduced. But what we're seeing right now is half of U.S. tenants can't afford to pay the rent. But rent prices impacted by apartment building boom, Redfin chief economist says. And so when you see this, median rent prices over $2,000 in certain parts in 2023, and now you're seeing a 50-year high in apartment construction, these landlords are saying, you know what? They're lowering their prices. They're saying median monthly rent prices at an all-time high, 2023, mainly due to high mortgage payments that push potential buyers into the rental market instead. However, prices have since changed due to the apartment building boom. There are many vacant properties right now, and the supply jump that has caused landlords to lower prices. So not only that, you're seeing a lot of accidental landlords, people that bought properties that are now underwater. They can't sell these properties, and they don't know what to do. So they're renting them out. You're seeing a lot of people renting these properties. Rent prices impacted by apartment building boom, right? You're seeing this really pick up. Where are rents falling? New York, Jersey City, prices surges, market cools in the U.S. Austin apartment booms and rents went down. Now some builders are dismantling the cranes. Rents have started falling in Raleigh, North Carolina, right? So you're starting to see this Gen Z prefers renting over home ownership. This is going to be the biggest trend over the next couple of years is, owning a home is going to be, people are going to say, you know what? They're going to lift their nose to owning a home. They're going to want to rent. They're going to want the, quote unquote freedom. But the reality is they're not going to be able to afford to buy, right? And so people really need to, that have a goal of owning, really need to look at the next couple of years, the biggest opportunity to do that. Because after 2027, I believe, these large corporations are going to be stepping in and they're going to be buying up everything. They're going to go out there buying up everything. So you want to own your piece of property or 2 or 3 pieces of property or however many you intend to own. You want to do it over the next couple of years, and you want to have really smart debt on that property if you can't pay it off outright. But you want to have really, really good assets, because at the end of the day, the dollar is going to continue to erode. I personally believe inflation is going to get worse, and I think we're going to see dollars continue to have smaller and lower purchasing power as we start to see other countries start to de-dollarize over the coming several years. One fascinating aspect of this entire situation is as rents are declining and evictions are continuing to pick up, and we're starting to see landlords getting pushed to the brink, the volume of loans extended recently and coming due this year is so high that the Mortgage Banker Association recently revised upward its estimate of commercial real estate mortgages maturing in 2024. They're saying from $659 billion to $929 billion. 20% of all commercial real estate debt this year is what they're saying. Now you think about this. 1 in 5 commercial properties with a loan has to go back to the bank to get a new loan this year. And if they don't, they're going to have to give the keys back to the bank. So what does this mean? In a situation where mortgage rates basically tripled from 2.5%, 3% a few years ago to now in the 7s, insurance and taxes are up, and rents are softening, and vacancies are increasing. What does this mean? It means it's a big, big problem for these landlords. So it's not only just the everyday American that's getting absolutely pummeled right now by the rising cost of living and record high debt. It's also the investors, the landlords. This situation, this ripple effect, is going to continue to grow. And this is going to be the new story. So this is 2021. Bloomberg put this article out. America should become a nation of renters. Imagine this. 5 years ago, if someone told you that, you would have been extremely, probably like, what? This is ridiculous. Even now, it seems still kind of ridiculous. But this is getting normalized. This is what's going to be the reality, I believe, coming very, very, very soon as we start to see all these dominoes start to take over. And we start to see more banks start to report tighter lending standards for nearly all residential mortgages. Fed says bank tighter credit standards in fourth quarter. U.S. banks see loan demand rising in 2024. Yeah, there's going to be, of course, there's going to be a lot more demand, but there's going to be probably less people getting these loans as banks start to, pull back on their lending. Commercial foreclosures are steadily rising. A week ago, Chicago among the top cities seeing rise in foreclosures, warning to upstate homeowners. You're seeing, here come the HELOC, mortgage balance delinquencies, and foreclosures 4 weeks ago. You're starting to see it. This is happening across residential mortgages, commercial mortgages, auto loans, how many cars are repossessed each year, right? You're seeing these loan delinquencies keep going up. 3 days ago, repossessions on the rise. So you still, how to file for bankruptcy and keep your car 3 weeks ago, right? Is this the soft landing that we were all promised? The 2% inflation that was going to be incoming, that, this inflation problem is just transitory? Or are we walking into the erosion of the middle class? I'm personally betting that it's probably the erosion of the middle class. We're basically already in that process right now. The next couple of years, I believe, are going to be extremely important. I really do. So if you are an employee, you're a business owner, you're an American, next 12, 24, 36 months, make the smartest decisions you possibly can. Put yourself in the best position you possibly can so you can go out there and start to acquire assets. You can go out there and really start to do really, really, really big things. Because when you look at these numbers, this is a big issue. And a lot of these people are going to be forced to sell. They're going to be forced to do whatever they have to do to keep their head above water. Drop below. Let's have a conversation about this. And if you'd like to fix your credit to position yourself for this massive wealth transfer, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any issue at all on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session for tomorrow. Catch you next video.